Hello traders, Gary Wagner here, just about 12:30 in Honolulu, 6:30 in New York. It is Friday. Happy Aloha Friday, as we say on the islands. It is May the 8th, 2020, and this is the Daily Report for gold and silver. And what a way to end the week. We had the U.S. Labor Department's jobs report coming out, and they stated unemployment at 14.7 and new unemployment claims added in April at about 20 million. Now, because the forecast was 22 million instead of 20, and the forecast for unemployment was between 15 and 16, even though the numbers and the data that came out were dismal, were gloomy, that really indicated a further contraction of the U.S. economy, traders bid the precious metal lower and pumped up the stock market. It is somewhat perplexing. While I understand that monetary easing by the Federal Reserve does have the effect of moving both gold and the equities tandemly in the same direction, we certainly did not see that today. We are currently in a trade. We were not stopped out, although it came close. We'll talk about that trade in detail when we look at our charts, but first, to the price board. Traders, even with an extremely depressing U.S. Labor Department's jobs report today, we did see a strong decline in the precious metals, and inversely, the U.S. equities markets moving to higher ground. Confounding on the surface, gold, basis the most active June contract, is currently down $21 at $1704.80. The high $1735.50 and the low $1703.10. That number is important because it does keep us in the market. We were not stopped out. We'll talk about that when we look at our charts. Spot gold lost about $14.50 at $1,700. But what you can really see is the spread between physical and spot has now declined to about $4 or $5. And that's a far stretch from what we saw a few weeks ago when we had a spread of $30, $40, and even $50. Platinum gained about 1%, $790.90. Palladium gained about 0.75% at $18.50. Silver gained over a full percent today at $1577.50. And all of that was with slight tailwinds from a weaker U.S. dollar. Let's take a look at our technical studies. The last couple of trading days have certainly been unusual in that we had recognized and identified a compression triangle, a simple pennant formation, which is characterized by a series of lower highs and a series of higher lows. What is interesting is that when we looked at the market on Wednesday, it actually touched to the bottom of the support line created by this triangle. Then yesterday, it opened just below it, but closed above it. And that, to me, was pretty strong. It did signal a potential breakout, especially when it was my assumption and belief that the jobs report coming out today would be pretty dire indeed. In fact, it was. But because it came in slightly under estimates, we saw a strong sell-off in both gold and silver. What we can see when we look at today's single candlestick is the fact that it did open above but close about the midpoint of the compression triangle. And the other thing that's extremely noteworthy is you can see this blue line that comes in right here, and that represents a moving average, and that moving average itself is a 21-day exponential moving average. So the fact that it was able to trade above that, I think, is fairly significant, but the fact that it sold off as harshly as it did, I believe, is a little bit perplexing, because even though we came in under expectations, these numbers are dire at best. They suggest that it is going to get much worse before it gets better. And we've got over 30 million Americans out of work. That's 3 out of 10. And we haven't seen these kinds of numbers since the Great Depression, because from our research, the Great Depression resulted in an unemployment rate of 24.9. There are analysts right now that believe we're closer to 20, with the official number at 14.7%. Traders, although the trade is currently against us, the stop that we placed at 1701 did hold. The low today was 1703 and change, and I wanted to spend a moment speaking as to why we put our stop where we did. This is a very short-term retracement from 1683 up to 1735. It's this last leg of the rally. As the market came down, we looked at various price points where we could look to find support, the 38 being one of them, and the most important one being the 61.8% Fibonacci retracement, and that comes in at 1703. So the thought process behind placing our stop right around 1700 at 1701 was to place it just below that key area of 61.8%, at least for today, is actually optimistic when we consider the pattern in which gold is traded to. To look at that, we would pull up a daily chart, but to simplify it, today was a down day, yesterday was an up day, the day before that was a down day. Then we have two doji crosses, a green day, which is a up day, and a red day, a down day. In other words, recently we have been seeing candle color alternate almost on a daily basis. And traders, lastly, I do want to take a look at the differential between futures pricing and spot that are extremely close. The top chart represents a candlestick chart of gold futures, the continuous contract fixed at 1704.80. The bottom represents Forex or spot gold, currently at 1760 cents. What is most interesting when we compare futures to spot pricing is the differential or spread between the two prices. Currently, we're looking at about a $3 to $4 spread. That is a much narrower spread than what we witnessed a couple of weeks ago when we saw the spread go to $30, $40, $45 between the two prices. This has been Gary Wagner, wishing you as always good trading. We will talk to you on Monday for the next daily update and review. Bye-bye.